Today, I want to mention that your stock track assignment is due on Wednesday at 10 a.m. It needs to be submitted by one of your group members. So it's a group project, so it's a group submission. And I'll talk more about that in a second. So basically, today is the last day of trading for the first half of stock track, right? So basically, you don't have to do anything. So what's going to happen is tomorrow I'll look at the final rankings of all the teams, and based on your ranking, I will look at performance. Now, you needed a minimum of 5 trades, otherwise you get a 0 on the assignment. Okay, so make sure you've completed 5 trades by end of business today. Okay, so if your team doesn't have 5 trades, you can't get credit for the assignment. So I know some of you, Austin, the TA, was just here, are having trouble figuring out how to use the portfolio function of Bloomberg and getting that exported. So I'm going to give you an alternative for your group submission. So what you can do is tomorrow, as I said, I'll score you, but then you have to turn in a write-up. And the write-up is basically all the transactions that you made. If you log into StockTrack under the My Portfolio section, the third link down, it's called Transaction History. Now, actually, I must have logged me out. I haven't actually made any transactions this semester, so even though I'm logged out, I wouldn't see them. It'd be a blank screen. But if you log in, it's every trade that you've made. So if you didn't figure out how to put it into Bloomberg, then you can go to the StockTrack transaction log and print that out and submit that. Okay, so that's your transaction history. The other piece, the transaction history, are the write-ups. So for every trade, every buy, every sell, every short, every cover, you need 1 to 2 sentences. Why did you make the trade? Right? What was your rationale? So that also has to be submitted by Wednesday. Every trade. So if you bought a stock 3 times and you sold it 4 times, that's 7 different sentences, right? 1 for each one. So what you could also do is if you export from Bloomberg, or if you copied and paste this into Excel, you could just go over a column and next to every trade, just write out in that column, why I did the trade. It doesn't have to be overly long, like I said, 1 or 2 sentences, but just what is your business rationale for doing it? And that is half of the grade. So basically assume it's worth 10 points or 10%. And so the write-up is 5 of the 10 points, and then your relative position is going to be 6 through 10. So if you have the highest portfolio value and you turned in your write-up, then your team will get 10 points. If you have the lowest portfolio value and you turn in your write-up, your team will get 6 points. Everybody else will be somewhere in between. Okay? And if you don't turn in a write-up, regardless of your portfolio value, you get a 0. Okay? So make sure you turn in the write-up. So the way to work is StockTrack is broken into 2 parts for the semester. As of tomorrow, based on today's end-of-day trading, it's worth 4 points. So I'll take your score out of 10. So let's say you get 10 out of 10. That's 100%. And I'll take 100% and I'll multiply it by 4. You'll get 4 points. And everybody in your team will get 4 points. Assuming you turn your write-up, the worst that you could do is 6 out of 10, which is 60%, times 4, which is a 2.4. So the worst team would get 2.4 points, and the best team would get 4 points. Okay? And the other 6 points, by the way, will be decided based on the December closing date. Okay, so you'll keep trading, but this is the kind of mid-semester check-in on StockTrack performance. Again, due at 10 a.m. with a 15-minute grace period for all sections. If you go to Elms, under Assignments, then click on StockTrack Part 1, and here's where you would upload your file. I see some people had already started uploading. Questions about StockTrack? Hopefully pretty straightforward. All right, so what we're going to spend most of our time today on is creating the as-is valuation for Caterpillar, as well as the bull case and the bear case. So we're going to create 3 Excel files. At the end of the class, we'll then decide which of the 3 we think is most likely, and that will create our target price and our buy, sell, hold recommendation. Right? The other thing we're going to work on this week, which will start today, is the concept of multiples. And we're going to introduce how we can use multiples as an alternative form of valuation. And so for Monday, a week from today, you're going to have a jumbo assignment. I'm going to increase the points on that. And you're going to have 2 pieces to the jumbo assignment. So today, we'll complete the buy, sell, hold evaluation of CAT and a target stock price. On Wednesday, we will complete the multiples analysis of CAT and its peers. On Wednesday, I will give you individually another company in another industry, and you will have to do the same process for that company on the bull case, bear case, and as is, as well as the buy, sell, hold recommendation that you will write up. And you'll also have to do the multiples analysis, which you will write up and submit for next Monday's class. Okay? By the way, when you have done that, that is a dry run for your group project. Okay? The only difference is you're doing this one individually, and your group project, which is due a little under a month from now, about 4 weeks from today, when your group project's going to be due, you're going to be doing that one as a PowerPoint and a write-up as a group, but these are kind of the core parts of the valuation that you're going to have to complete. So that's what we'll be completing by Wednesday, and you'll see that we can use the model we've created as a reusable model, and we'll use that to value the companies for our homework assignments as well as for the group project based on what you selected last Wednesday. Okay, so that's our roadmap for the week. So with that in mind, let's go ahead and start with the concept of the as-is valuation. So for those of you that had trouble, under the Files section, I had created a folder called CAT Model on Elms, and I put up the file we finished last Wednesday, which is this file, Valuation Model CAT Part 2-video, because that was the one that I used with the video for last week. And you're welcome to start with that file. So if you were able to follow along and you got your file, use your file. If for some reason you had trouble figuring out how to get to the final solution, that's the final solution we ended up on Wednesday. So you're welcome to look at that file based on what was submitted today. Either one will work, but we're going to start with that file. Okay? So let me go grab that file. And I'll go to CAT Part 2 video. And I'm going to rename this file the CAT as is video. Okay, so the first thing we're going to do is, based on the name, we're going to create what's called an as-is valuation. So what that means is that right now, Caterpillar's stock price is trading, I looked them up in Bloomberg, at around $72 a share, $71.68. So our first step is in our model that we built last week, based on our ratios and assumptions, we had created an intrinsic value share price forecast of $65 a share. So in the as is, what we want to do is, using our model, we want to get that share price extremely close to the actual share price, right? And I would say within $1, right? But basically closer would be even better. So how do we get very close to almost 72 a share as opposed to 65 a share? That's the process known as an as-is valuation. And the goal here that we're trying to do is we're trying to understand what assumptions must the Wall Street professionals be making in their cash flow models to justify the current stock price. So we're kind of working backwards to figure out what are the key ratios have to look like to get to that share price. And here's the important part. It's not whether we agree with those, right? Because the share price is the actual share price. That's an observable data point. So what assumptions lead to that observable data point? That's the as-is valuation, right? Then what we're going to do is we're going to say, okay, what if we think CAT could do better than what those assumptions tell us? That's going to be the bull case. And what if CAT does worse than those assumptions tell us? That's the bear case. That's going to get us a range. And then we're going to use our judgment to decide what we think is the most likely outcome for CAT. And then we'll pick one of those, and that will create our target price and the buy, sell, hold. Okay, so that's pretty much the process that we're about to go through. Okay, so first thing I want to do is I'm going to start changing the ratios to change the stock price. So I don't want to keep jumping back and forth a lot. So what I'm going to do on this page is I'm going to add here the forecast share price. And I'm going to use a relative reference to equals off the DCF tab that share price. All right, 64.76 a share. All right. So I'm just referring to the DCF valuation tab share price equals a relative reference. So that way, every time I change a ratio, I don't have to keep flipping back and forth to the other tab to see what the share price does. I just want to make it convenient to quickly change the ratio, immediately see what the share price impact would be. Okay, so that's just to make myself a little bit easier. You want me to zoom a little bit more? Okay. A little bit better? Okay. All right. So, here's the thing. When I looked at CAT, what we really have done is we've created the first 6 years of income statement and balance sheet forecast that's created the cash flows, which has created the valuation. So what's most important for us is to create that 6-year forecast that is more realistic of the income statement and balance sheet. Now here's the thing. There's a group of analysts that work for Wall Street. One of them visited our class last Monday, and basically they probably know more about CAT and its peers than we will ever know because it's their life to know about it. And so the wisdom of Wall Street is then going to be wrapped up into their financial forecast, which is going to show up as the consensus estimates in Bloomberg. So if I go to Bloomberg and I go to the earnings estimate database, EEO, this is what I would call the current wisdom of Wall Street for CAT. Because this are the analysts that cover CAT, their guesses for what's going to happen to CAT, and somewhere plus or minus on a, some standard deviation is going to be where most of these analysts are particularly making their guesses. So that's the point. I don't think our guesses are going to be better than their guesses for the short run, and their guesses are going to be the ones that the institutions are relying on to help them establish a baseline for the valuation of CAT. So rather than creating our own guesses, since this is a real-world class, we're going to leverage the guesses that are already made. Now, the next thing that you'll notice is there's a column in Bloomberg that has a pound sign in it, which is the number of estimates in the consensus. And you'll see that for most publicly traded companies, that the first 2 years are more heavily forecasted, and as you go to years 3 and 4, they're less heavily forecasted. Right? Now, I'm not going to post this yet, but sometime soon, I got an email right before this class started from Nicole from Morgan Stanley, and in her email, she sent me her actual valuation model for CAT. So this is the one that Morgan Stanley creates as a sell-side analyst. And I'm going to post this on Elms. She said it was okay because she told the class she was willing to share it. She sent me an email saying, here's the model, please share it with the class. Which, by the way, this is great because you actually see how Morgan Stanley creates their actual model, which is in the database, right? But here's the point, is that if you look at, and I barely looked at this before the class started, like I got this 2 minutes before I started this video. But one of the things that you'll notice is that she has a DCF which goes out a number of years, right? And when I go back to the consensus, you'll notice that her forecast for 2018 is not in Bloomberg. So, and that's pretty typical because the analysts are ranked. Because every time you put a data point into a database, the database remembers your guess, and then it's going to look and see how companies do, and it's going to track you against those guesses. So what you'll tend to find is that the analysts actually have forecasts going forward. Otherwise, they can't do a valuation of the company. But what they actually load to the consensus database is most analysts will go out about 2 years, but they don't go out many more years than that in terms of what they're willing to put their names on. Now, obviously, there's this guy, there's one person who was brave enough to put something in the 2018 number. I don't know who it is, but that's the point. You'll not see most people are willing to put their name on the line to guess that far out. Just too much uncertainty. So back to what we're going to do. We're going to use the most current 2 years because those are the most heavily forecasted, which I think there's the most consensus around because it starts to get murkier after 2 years to help us with the first 2 years of our forecast. So we're going to create 6 years of forecast. So we're going to start with the first 2 years of consensus. Now, what matters most when we do our valuation, go back to our model. And I highlighted this in gray, are these 3 variables. Well, let me tell you why. So we're trying to forecast free cash flow as the most important driver. And free cash flow has 2 components. It's gross cash flow and gross investment. Gross cash flow is no plat plus depreciation. So what really matters is our forecast of no plat. Well, if you look at our model, the 3 most important drivers of no plat are grayed out. It's the revenue, it's the EBITDA margin, and it's the tax rate. Right? Those are the most important drivers of no plat. And that is what we're going to spend most of our forecast on because that's 90% of your valuation are those 3 numbers. Everything else, I like to say, is like salt and pepper on the food. Okay? So you got to put some seasoning on it, but those are the most important numbers to your valuation. That's why there's so much time spent on earnings. Right? And it's not that the earnings matter, but the earnings help us figure out free cash flow, specifically the drivers of gross cash flow. Growth in sales, margin, and to some degree tax rate. Okay? Gross investment. Here's where our model setup helps us. All of these balance sheet items, most of those are operating invested capital components, are a function of sales. So the way our model works is if sales grows, gross investment grows. If sales shrink, gross investment shrinks. So our model is going to come up with a forecast for gross investment, assuming constant productivity. So if a company's investment rate stays fairly constant over time, then as the revenue goes up or down, the investment will go up or down. Obviously, we could change that around the margin, but I'm just telling you, most analysts tend to leave the investment rate to be fairly constant for most companies, especially most mature ones. So that's the point. What really matters to our forecast are these first 3 numbers: growth rate, EBITDA, tax rate. So that's where we're going to spend most of our initial time in the valuation. So here's the point. In my assumptions tab, I'm going to start creating some additional assumptions. Again, I'll make this a little bit bigger. So, first year is last reported year plus 1. I want to use relative references. Plus 1. And that plus another 1. So again, as my years change, it updates the forecasted years. So the first 2 years I'm forecasting are 15 and 16. Right? As I said, what matters is the forecast for sales and EBITDA. And I'll make these yellow because these are things that I will change. So here's the idea. In 2015, and I took a screenshot of this in the earlier section today, so I put the screenshots just so we all have common data here. Okay, and these are also the screenshots you'll use when you reuse the model. But basically, if I go to the sales for 2015, right now the consensus is 47,612 billion. So that's what I'll do here. I'll go to my Excel file. So for 2015, 47,612. And for 2016, the consensus is 44,151. For EBITDA, the consensus for 2015 is 6813. And for 2016, it is 6362. Add decimal place so it's a little easier to see. Okay, so that's the consensus estimates for sales and EBITDA for the next 2 years, in this case in dollars, for CAT. Everybody see that? Questions where I got that? Right off the earnings estimates. Right. So here's what we're going to do. We're going to go to the ratios, and for these 2 years, I don't want to put in my own guesses, so I'm going to, instead of making those yellows, I'm going to not have the fill color for that. Same thing with EBITDA. I'm going to get rid of the fill for those two because I don't want to change those. I want to solve for those. Right? So what is the consensus estimate for revenue growth rate in 2015? The formula for revenue growth rate is current year minus previous year divided by previous year. So equals left paren for 2015, so this is H2. I go back to my assumptions. I take the 2015 sales, which is assumptions B13. I subtract from the income tab 2015 revenue, that was last year's revenue, right paren, divided by 2015 revenue, which is H3. So assumptions B13 minus income H3 divided by income H3, which says, what is this having a problem with? Try this again. Equals current year minus, I think I had the wrong year. Oh, that's why, wrong year. G3. Yeah, I know it's a circular reference. There we go. All right, equals current year, 2015, minus income previous year, it's 2014, divided by 2014. So 13.7% decline. So if the market is correct, CAT's going to see a sales drop of 13.7% in 2015. In 2016, equals left paren from the assumptions, 2016 sales minus 2015 sales divided by 2015 sales, it's going to fall another 7.3%. So that is the current wisdom of Wall Street in terms of the revenue growth rate for the next 2 years. Negative 13.7% followed by negative 7.3%. Everybody see what we did? Questions about that? All right, in terms of the EBITDA margins, we have EBITDA dollars divided by sales is our EBITDA margin. So again, in 2015, equals the 2015 EBITDA dollar forecast divided by the 2015 sales forecast says that the market's expecting an EBITDA margin of 14.3%. For 2016, equals, from the assumptions tab, 2016 EBITDA divided by 2016 sales. So for the next 2 years, CAT is expected to have EBITDA margins of 14.3% and 14.4%. That's based on the consensus estimates that we pulled from the EEO screen. Again, questions about those numbers, where they came from, how we calculated them? Hopefully pretty straightforward. Oh, by the way, if you look down here, you'll also notice the share price has dropped to $28 because the model continues to have sales fall 7% forever, which probably is not going to happen, but if it did, we can see that that would be $28 worth of share price. All right, final number here that matters, I said, is the tax rate. Now, I'll unhide what we had hid before, but basically we said 2009 was an outlier, and if we look at the last 5 years, we think 27%, which was an average of the last 5 years, seemed like a reasonable tax rate, and I'm going to use that as my go-forward tax rate, 27%. All right, so what I want is what I think in this cell is a reasonable tax rate for CAT to pay on a go-forward basis. As a starting point, we use the average of the last 5 years. I can see that 27 plus or minus 3% is generally the range they've been in, so I'm pretty comfortable leaving it somewhere around 27, so I'm not going to change that number. And I really just want one tax rate for the future. Okay, so that's my next step, forecast the tax rate. I'm not going to change that forecast. Then I go to the Assumptions tab, and I want to make sure that I have a current WACC. My WACC is 6.7%. So what I'm going to do for the WACC is come in here, type in WACC, and we're going to use the Bloomberg WACC. And Bloomberg is estimating a WACC of 6.1% for CAT. Again, I took a screenshot of this earlier, but basically I'll change this to 6.1. And oh, by the way, that's going to give me share price of 38. Right? Now, in just a minute, I'll make this a little bit smaller. In just a minute, we're going to start talking about the next 4 years and what we think is going to change. Right? But before we do, the other assumption that's going to matter is something called the CVG. That's the continuing value growth rate for the company. So year 6 into perpetuity. It's a very long-term growth rate when the company's mature. Okay? So in this case, CAT's already a fairly mature company. And as Nicole talked about, CAT is mostly exposed to Europe and North America. Okay? Now, we could either go through the Morgan Stanley presentation to learn this, or in Bloomberg, if I go to the FA screen, which is the historical financial statements, there's a tab called Segments, and I can look at segments by geography, and I can see that for 2014, 37 out of 55 billion of CAT was North America and Europe. So 75% of their sales are coming out of North America and Europe. Right? So they're more tied to North America and Europe than they are to Asia and Latin America. So here's the point. When you're mature, you're probably going to grow at the rate of the economies that you're kind of selling in. And since most of CAT sales are in North America and Europe, and historically for the last 100 years, those economies have been growing about 3% a year, I'm comfortable leaving at 3%. Now, if you believe PIMCO started with Bill Gross, who left PIMCO in a nasty fight, was making an argument that going forward it might be closer to 2% in Europe and North America for the next 100 years, not 3%. So if you believe PIMCO and Bill Gross, and you believe, now I forgot who he works for, he got the big nasty fight, left PIMCO, but basically if you believe that theory, then we're at 2% for North America and Europe, 2 to 2.5%. We're a little bit higher for Asia, Latin America, but when you balance it out, 3 seems reasonable to me. Okay, so I'm not going to change that growth rate, but that's an assumption we could change. But I'll leave it around 3%. But that's actually why we started as 3% as a placeholder. All right, so now what that means is I have to change my ratios to get closer to that $72 stock price. Right? So the first thing I want to do is I want to look at revenue growth. So again, I don't think CAT's going to start falling forever. So 2 things I'm going to do. 1, I'm going to go to IBIS World. So in IBIS World, which you can get to off the VBIC homepage, IBIS World is the industry reports. So if I go to IBIS, I type in CAT, Caterpillar, I do a search, then I'll see they're in 2 reports here. They're in tractors and agriculture machinery, they're in construction, machinery, and manufacturing. So I click on tractors, I can download this as a PDF, this is the EIC analysis, and if I click on key statistics, then this is IBIS's industry growth for tractors and machinery. Tractors and agriculture machinery. So I can see that for 2016, 17, 3%, 4%, followed by 4% and 3%. That's the growth rate going forward. If I go back, I can then look at the report for construction machinery, and construction machinery is expected to grow at 3%, 6%, -1, -3, and 7. Okay. Then I can go back to Bloomberg, go back to my EEO, and I could change this to growth. And I can see that starting in 2017, I know I have less data points here, but I got growth of 2% followed by growth in 2018. Remember, that was just one person. They said 9.6%. But nonetheless, there is a growth of 2 and 10. So I'll just put that in here. So as a starting point to my model, let me just put in 2 and 10, which I don't find to be too unreasonable, only because the 2% for 2017 is somewhere in the range of what the IBIS reports for the two major segments that CAT is in. And the 10% says that that was the year that they predicted a little bit of a blip. But here's the thing, assuming CAT's got a dominant market position, I could see why an analyst might predict that they would do better than their peers in an up economy. So call that 10%. Oh, by the way, now I'm at an $81 stock price, right? But then remember that the analyst reports for IBIS said one segment that CAT was in was going to grow at around 3 to 4%, and then the other segment was going to be 0 to negative. So again, what I'm going to do is I'm going to say for 19 and 20, I'm going to call that around 2%. Now you'll notice that every time I'm making a change in a data point, I'm articulating a rationale for why I'm making that assumption. That is something that you have to be able to do. And that's what you're going to be graded on. Because finance is storytelling, right? And that's what you're doing. You're telling a story with the numbers, right? And the story is based on the assumptions that go into these numbers. Because we're not trying to solve an equation, and we're not trying to go to historical data that has an absolute answer. We're looking into our crystal ball. So when we're predicting the future, why are you making the predictions that you're making? What's the basis for that? That's just as important as the numbers that you make. So when you do your write-ups for your homework and talk about your group projects, what's going to matter is not just your numbers, but why did you make the numbers choices that you did? What was your rationale? And so that's what I mean by storytelling. So, for example, I've already told you why I thought 2 and 10% were reasonable numbers, how I got those numbers, and why I'm going back to 2% in 2019 and 2020. Right? And given that, how that gets me to a $65 share price, and I still need to get to 72, which suggests that CAT's margins have to get better in order to get to that share price. Right? So with the margins, and I can see their historical margins, which are better than the forecasted 2 years. So if they start to return towards the historical margins, what if this went to 14.7? Which is where they were before in EBITDA in 2010. Now I'm at $70. And then I go to like 14.9 or 14.8. Then I'm at 71.80. And oh, by the way, 71.49. Right? So here's the point. I don't know if I'm exactly right with the growth rate and margins. Like the growth could be a little higher and the margins a little lower. The margins could be a little higher and the growth could be a little lower. But somewhere in this range, what I'm starting to understand for CAT is that the margins that are expected for CAT are probably less than what they were the last few years in a much better market. And they're probably not expected to return based on the current share price to those level of margins anytime soon. And that the growth is going to be more tepid in the next few years. Right? And that's probably what explains the current share price. Right? Now I'm going to continue based on what we heard from Morgan Stanley last week and just generally reading the papers. I mean, a lot of the problem that CAT has is CAT makes heavy construction equipment, which is going to be tied to building stuff. And right now, people are not digging as many mines. Right? Commodity prices have collapsed. People are not building as many buildings. People are not building as many roads and bridges and infrastructure, so they don't need this heavy industrial equipment. And so that's the point. That's why they're struggling in the short term. One of the other things that Nicole put in her presentation, which I thought was a great, interesting slide, is slide 67 that she shared with us, and this is on Elms, showed the average age of the truck fleet has fallen from 6.7 years to 5.9 years last year. So what this tells me is she's talked about the notion of a replacement cycle, like your big Tonka toys, your earth movers and dump trucks are eventually going to have to be replaced. But that's the point. They got relatively new stuff. And in terms of the replacement cycle, they're probably further away from having to replace stuff that they just bought in a relatively tepid market. So that's the point. When they start growing, it's not like they have a bunch of old stuff that's got to be replaced for them to grow. They just bought a bunch of stuff, which they can probably use to grow, which means that the growth is probably not going to be as strong as it otherwise would have been if they also had very old equipment when they hit the next growth cycle. So I think that's one of the reasons why it would make sense that Wall Street might be more concerned about the margins in the next growth cycle, right? Because the next growth cycle could be tougher competition because people are going to be fighting for that growth because it's not like I can just sell everything that I can produce. And there's a glut of stuff out there in the market today. So I think it's going to take a few years to work on the glut, and that's what's supporting this kind of base case of the as-is valuation. Questions about any of that? How I came up with that story? Because you're going to have to tell me a similar story. Yes?
So you went back to the industry report.
The industry report? Okay. So in the IBIS report, I was on key statistics, the last part of the report. You can also download a PDF, but in all the IBIS reports, the key statistics will have an industry size and a percent growth. It's not perfect because obviously companies can be in multiple segments, but at least it gives me some magnitude number so I'm not just throwing darts at a board. Right? Other questions? All right, so I'm comfortable that we have created the as-is case, which is also a hold. All right, so now what I want to do is say, okay, so I'm going to save this, and I'm going to create a second copy, and I'm going to call this my bull case. So what if things start to go really right for CAT? Right? How good could it get? Right? And what could be good about going right? Right? Well, one of the things about the better scenario is that growth, which you can see, was actually pretty strong when we started to recover from the last recession and went into a bull market, could be much better than 2 and 10%, especially after falling as much as it did. So one of the things is CAT could grow at, 4% and 14% and then 4% thereafter. They could grow much faster, right? And one of the arguments for this, I was telling the last class, which is this is just scary data. But 1 in 10 bridges in the United States is structurally deficient and has outlived its useful life and should be replaced. And some states are worse than others. The worst bridges in the country are in the state of Pennsylvania. 1 in 5 roads and bridges are structurally deficient by the engineers, and they're not safe to drive on. Yet we're driving on these every day. And it's going to cost us, and this is the reason why you're driving on unsafe roads and bridges, approximately $2 trillion to basically replace these roads and bridges. And there's no tolerance by the U.S. government right now to do that. So that nobody wants to fund all of the infrastructure spending that needs to be spent. This is just in the U.S., right? But what it's going to take is people to die. And that's what's going to happen, is people are going to die. They're going to be driving down 95. There's going to be a collapse. People are going to die a horrible death. And at that point, Congress is going to get serious about fixing 95. And it's going to take that. And by the way, the worst part of 95 goes through downtown Philadelphia. So seriously, you should be avoiding that road. Don't drive 95 downtown Philadelphia. Like, the concrete has cracks in it. The steel beams are rusted. There's structural integrity issues that are just going on down there. The engineers are saying this, and nobody in Washington cares, right? So, again, I'll stop editorializing, but here's the point. That's another part of the upside, is at some point when there's a terrible tragedy, we will start spending on the roads and bridges upkeep that needs to be done. Because these roads and bridges were built with a 40-year life, and they've been around for 60 or 70 years, and nobody's bothered to replace them, right? And that's, unfortunately, the part of the upgrade cycle that we need to do. When you start building that, you're going to need some of CAT's equipment to start doing that. So that's the point, is outside of what they're selling, if the roads and bridges segment also starts to take off, then I could see CAT doing pretty well and seeing even faster growth in the next few years. And that means that they might get better margins. So instead of 14%, maybe they'll get closer to that 15 range, which they were in historically. So I'll make this like 15.1, and then eventually 15.4, which is where they were in 2014. And oh, by the way, that's a $91 share price. And they're at 72 today. So that would be an argument to say CAT could be undervalued if that were to come true. And now might be a really good time to buy because CAT's on sale. What I'm then going to do is I'm going to go back to my as-is file. And I'm going to create the bear case. So file, save as, bear. What could really go wrong for CAT? Okay. Well, one thing that could really go wrong for CAT is they get no margin improvement whatsoever. And they just stay in a very tough margin environment on a go-forward basis. And that there actually isn't any growth in 2017. 2018 is no more than IBIS says, and 2019 and 20 are also a no-growth environment. Well, that's a $57 share price, which is $15 or $17 below where they are, $15 below where they are today. So if they get no growth and a tough margin environment, then that would be a sell. And you should get out of CAT right now because one could argue that a lot of the growth has come at the infrastructure spending coming out of the downturn in 2007, 2008, and China is not going to return to its glory days. And the U.S., we're already starting to see signs from this, is starting to head towards more troubled economic times. And the construction market's not going to recover because we have a lot of oversupply. And even when it does, there's a lot of equipment already in the channel that they have to work through. So basically, it could be some really tough times for CAT the next few years in terms of their growth. Even if the market recovers, unless it recovers substantially, they're just not going to get the sales lift. And it's going to be a competitive market because all of their peers are going to be fighting for market share, which is going to continue to put margin pressure on the business. So sell, get out. Here's now the question. We've created 3 scenarios. Which one do you think is most likely? Because that is the important question. So we've given a range of possibilities. We've given kind of scenarios for what each of the stories could come into. Which one do we believe? So we're a sell-side analyst. We have 60 to 100 funds that have between $1 billion and $30 billion of money to invest. They're investing in 100 to 150 companies each. They don't have time to do the research. That's why they're paying us to give them recommendations on what sectors they need to be in and who they should hold. So what should they do with CAT? Should they hold on to CAT? Should they dump CAT? Should they buy more of CAT? And if I'm not in CAT, should I get into CAT or should I avoid CAT? So what do we tell those funds that are our clients? Buy, sell, hold. And what do we think is a fair price for CAT? I'll open it up to the class. I gave you my 3 scenarios. Now what do you think? Which one do you think is most likely? And what would you recommend? And recognize there's no right answer here because we are looking into our crystal ball. This is why I call this the art of valuation. And I'll give you another hint. If you look at the actual analysts, of the Wall Street analysts, not everybody says hold. 5 say buy, 4 say sell, and 20 say hold. By the way, Nicole from Morgan Stanley, who was here last week, where's Nicole? She is a hold with a $65 stock price target, and she updated that on October 22nd, right after the CAT earnings call. So what do you guys think? Buy, sell, hold. Which scenario resonates most with you, and why? Yeah.
I'd say hold because the evidence isn't strong enough in the direction to make it cut the same. So,
All right. Which evidence do you have the most trouble with?
probably the bear case. I just don't see it going to 0 growth, 4% for 1 year. I would say that it's more likely that construction projects will pick up.
Okay. Because it is a cyclical business. And so therefore, in the down cycle, we almost get confirmation bias. Does everybody know what confirmation bias is? You're basically looking for facts to support an already preconceived conclusion. And that's one of the things that when you get a cyclical business is when times are bad, we can't possibly see times getting better. And so therefore, we almost look for reasons for time to stay bad for a long time. And maybe that's what you're saying, is that you just don't have the confirmation bias. You think that the bear case is unlikely because the evidence says that we go through cycles. This is just a down cycle. There's going to be an up cycle, and that's okay. But continue on. Why not the bear? Why not the bull case? Why not a buy?
Well, I mean, I don't really know much about it, but like you were saying, I don't see the government chipping in a lot of money to do that, but I guess it is possible. And I think just like in general, more construction projects will start taking off. So I would say it's kind of leaning towards bull, but
Okay.
not too much.
So again, there's still growth in the whole scenario, and you're more comfortable with the middle ground. And by the way, that's where most analysts are today, saying a very similar story to what you're saying. Okay. Does anybody disagree with that one? Does anybody have one of the think now's the time to get out of cat, stay away, dump the stock, avoid the stock? Any sells? No pessimists in this room? Yeah.
Depends on your investment horizon. They get pretty good dividends, about 4%.
I'm sorry?
They get pretty good. They have like 4% dividend yield.
Okay.
They also like dismiss, I think, 30,000 or 70,000 employees. So in the short run, their margins should improve.
Well, even with all that information, Wall Street's seeing margins of decline to 14.3%. So, for better or for worse, the next 2 years, that is the improvement to some degree. It means it's not going to get as bad as it could have been. But that being said, So are you on the bull side? Are you saying you like them and buy because you don't see any downside and you see just upside? Okay. So that's a legitimate argument, which is assuming, and that's the other assumption, they don't cut their dividend, that their dividend yield's pretty strong and they got more upside. So you like the idea that it's almost like an option with some upside, and they're undervalued given that their upside is not really priced in. There's no real downside risk, so you'd actually say buy. Just elaborating on what I think I heard you say.
Yeah.
Okay. So I got a bull and I got a hold. Do I have any bears? All right, so let's just do this by show of hands. How many people say buy? Just by show of hands. So I got 1, 2. How many people say hold? All right, and how many people say sell? Okay, 1. All right, so that distribution is not too dissimilar to what Wall Street actually is doing. And again, maybe there's some confirmation bias here working because that's what you're seeing the data. But nonetheless, that would be the opinion that we would have. I'll just say after now doing this 3 times and listening to Morgan Stanley last week, my view would be hold as well. Right? I don't see a catalyst in the short term that basically says that things are about to change dramatically and have dramatic upside. And I think there's more downside risk than upside risk. So to me, I would probably say let's find some better opportunities elsewhere. And if we start to head towards a bull cycle, then consider cat. But right now, I don't see a lot of upside in cat. So, because again, even with some growth and improved margins, we'd have to see that to get to their current share price today. So again, from my perspective, I think there's just a lot of risk. So I'm in the hold category. I wouldn't sell it. I take the option approach, but I also wouldn't be recommending that people buy it, not at this price. Right? But that's the point. We have to stake our point of view. We have to come up with a rationale for why we're making the point of view we're making, and then we have to articulate that. Questions? Yes?
What did you change besides values for revenue growth and the EBITDA? A lot of us over here getting 57.6.
Why was what? I'm sorry?
A lot of us over here getting 57.6.
Yeah, actually, I had 57.26 also.
Okay.
Did you change anything besides growth or EBITDA?
No. Now, I used an equals from the previous years, not a typed in hard numbers. So that could also affect rounding, depending on how you did it. Or there's just a ghost in my machine with Excel. So it could be the virus. It's also possible. Because I believe it or not, I've seen 2 Excel spreadsheets with the same numbers and different results next to them. And it doesn't make any sense. But I've seen it happen. So, as I said, for purpose of this exercise, you're not going to turn this in. So even if you're a couple cents off, it's okay. What matters more is you understand a little bit about the process that we just went through, because this is the process which we're going to repeat on Wednesday with another company in another industry, and that you're going to have to repeat the following Monday on your own as an individual assignment. Okay, so you're going to actually have to do this yourself, except you're going to have to write it down, and you're going to put it into 500 words. So that's going to be part of your Wednesday assignment for next Monday. All right, and I'm not going to tell you who the industry and company is until end of class on Wednesday. All right. So, questions about the process, what we just did, why we did it, how we did it? Okay. So, part 2 of this week that I want to set up is multiples. Okay. So, I loaded up this morning lecture note 6. And multiples, also known as comparables or comparables. And right on cue, Microsoft wants to update everything. So maybe it heard that I had a bug and said, here, take the most recent software. All right, so also called comps, which is a shortcut for comparables, but it's a different type of analysis. And here's the key. Wall Street really likes multiple analysis for a couple of reasons. Right? One, it's easy. It's much easier than doing a DCF. And 2, it's based on actual prices. Like when we just did the buy case, the sell case, the bull, the bear, and the hold case, our forecast could be a fairy tale, and probably are, because it's going to be really hard to predict the future to figure out what the ratios are actually going to be to get some sort of intrinsic value. When you use multiples, you actually start with the actual share price of the company. So it's based on observable data, right? So that's why Wall Street likes multiples, is because it's based on real prices as opposed to potential prices based on a series of assumptions. Right? So they have to give you the same answer, and we will triangulate, but nonetheless, that's one of the reasons why multiples are popular. Multiples are just a way of looking at similar prices, looking at the prices people are paying for similar assets. So for example, if you're shopping for a pair of jeans, right, why would you pay $85 for a pair of Levi's versus $350 for a True Religion pair of jeans, right? Because basically, they're just jeans, yet people will pay a lot more for one brand than another brand. Why would you pay, I think they're called Red Bottoms by Christian Louboutin, $800 for a pair of Red Bottoms by Christian Louboutin versus you go to a cheap, shoe store in the mall and you can buy them for $40? Right? Why would you pay that premium for an asset? It's no different than why would you pay the prices that you would pay for a company, right? So obviously there's reasons. You like the design, you like the brand, right? You like the status associated with it, you like the quality of the material that they use. So you're putting something into that when you buy that. Otherwise there would be no reason to pay more for something versus something else. Right? As a matter of fact, my sister just bought a house in Denver. And Denver is absolutely ludicrously crazy with a capital K, right, in terms of the housing market. The house that she bought, when it went on the market, there were multiple bidders at 9 a.m. ready to go and auction off the house to see who could bid. And they had to pay more than the seller's price for the auction. In fact, one of the houses she bid on, they had to actually put their names in a hat just to get qualified randomly to overpay for the house that they were going to want to bid on. I mean, that's Denver. It's like DC in 2004, 2005. So what's now happening in the Denver market today, right? But the point is that you have to get an appraisal on a house to justify the loan. Well, how does the bank actually do an appraisal on a house? Anybody know? Yeah.
See, check the neighborhood, see what other prices of houses get sold recently.
And do you know what multiple they're going to use? What the actual ratio that matters to the banks? Anybody know? It's actually called revenue per square feet, or revenue per square foot. So what they're going to do, as you said, is they're going to look at the last, say, 6 to 12 months, similar neighborhoods, and they look at the sales prices of actual sales of houses. And they're going to look at how many square feet those houses had. And they're going to divide. And that's going to give them a revenue per square foot. They're going to average out the revenue per square foot in that area, and they're going to say that's the starting point for your house. So how many square feet times that number, that's the starting point for the appraisal. But then what the appraiser is going to do is he's going to move that up or down slightly based on other factors. So what other factors do you think the appraiser is going to look at to move the appraisal price higher or lower? What are the other factors? You know, buying a house. Yeah.
Quality of the local schools.
Yeah, so school districts, that could have a huge impact.
How well the person's maintaining the house.
Yeah, what's the condition of the house? What else? How many
Big yard,
bathrooms?
Big yard, pool.
Size of lot. Does it have a pool? Okay, what's the location of the house? Meaning, is it on a cul-de-sac? Is it on a river? Is it on a lake? Is it on a busy street? You know, that could all affect the price of the house. And then they're going to adjust. Think about that as a metaphor when you think about multiples for companies. So there are 6 adjustment factors for a multiple of a company. 1 is sales growth. 2 is expected ROIC. 3 is the risk, the cost of capital. 4 is the expected tax rate. 5 is the non-operating items. And 6 is the capital structure. Those are the 6 adjustments that will determine whether your multiple is higher or lower. So by the way, when you do something called a price to earnings multiple, PE, which is the simplest and most talked about multiple out there, it's actually the hardest multiple to explain because a PE is a function of all 6 of those items. Right? If you go back a long time ago to a faraway place on September 2nd in this class, which I know seems like forever, we started building a key value driver worksheet, and one of the things I showed you is how the key value drivers can create the concept of a multiple, right? And so here's the point, is that that's actually the idea, is those 3 factors, growth and spread, or growth, return, and risk, cost of capital, are the 3 most important factors in determining a multiple. So what I want you to start to understand is when you look at a multiple, what you're seeing is an expression of growth and spread, right? And we're going to make a bunch of assumptions, right? Now you probably know the old thing about when you assume, you make an ass out of you and me, right? Which is how you break out the word assume, right? But when people do multiples analysis, they actually make a lot of assumptions. So here are the assumptions people start to make. If you're in the same industry, you probably have a similar tax rate. If you're in the same industry, you probably have similar capital structures. If you're in the same industry, you probably have similar non-operating items. And if you're in the same industry, you probably have similar cost of capital. So 4 of the 6 items we'll assume are pretty similar and are not differentiating factors. So the real differentiating factors are expected growth and expected return. And those become the most important part of understanding the difference in multiple. So when you look at a multiple, you should expect that you're looking at the difference in growth and ROIC as just being represented in a result in a number. So just as we work backwards to figure out the as-is valuation, you should be able to think backwards to why is a company trading at a premium or a discount. Right? So let me give you an example with CAT. So one of the things we're going to do in our next class is using the RV section of Bloomberg, we will look at a company's peers. And by the way, this is another challenging part of multiples, is we have to figure out who are the right peers to evaluate. Right? So Google and Twitter are not good peers. Why not? People will use Google and Twitter as peers, and they'll look at their multiples, but they're actually not very good peers. Why not? Yeah.
Google does kind of something different than Twitter does. Twitter's more social media and Google's search engine and they revenue like I guess it's the same way, but I think Google does it better.
So to some degree, but I think that's the key word, is that they're in slightly different, I'll use the GICS comps, which will put Twitter on this list. And if I look at, for example, the comp sheets, I'll see that the PE for Twitter is expected to be 95, where the PE for Google, which is now Alphabet, is expected to be 25, right? And so that's the point. It's not only are they not different businesses, they're at different stages of their life cycle. Like Twitter is still a very young company with an unproven business model that is still evolving. Google is now a much more proven company, and they're starting to become a much more mature company. So as a result of that, what I'm doing is I'm comparing an apple and an orange. So even though they're both, you could argue, social media, if you wanted to brand it more broadly, because they're at different stages for expected growth and expected return, they're actually not the world's greatest comps to put together. Yet people will do that because they'll both say, oh, they're tech companies, so all tech companies should be on the list. So one of the hardest parts of the multiple analysis is finding appropriate peers, right? And appropriateness doesn't just mean that they do the same thing, because they need to have similar growths and similar returns. Otherwise, they would actually have different multiples for their business. Same thing with an Apple, by the way. You had Apple to this list. Apple I don't see on this list. So let me add Apple to this list. You'll see that Apple's PE is 12.6. So again, there's an article this morning about Apple. They're going to release their earnings tomorrow. And the question is, what's their growth in iPhones going to be? And most analysts are looking at low to mid single digits. They're looking at 2 to 6% growth in iPhone sales versus 12 months ago when the first iPhone 6 came out versus when the 6S just came out. So that's the point, is that Apple had this miraculous quarter a year ago, sold more dollars in profits than any company in the history of the world. And basically, a year later, can they do even better than that? But that's the idea, is that Apple is now a more mature company, so they're going to have a different multiple than Google, which is going to have a far different multiple than Alphabet, which is going to have a far different multiple than a Twitter or a LinkedIn. And so even though people would say they're comparable, they're not as comparable as they may look. That's a hard part of the multiple analysis. So let's go back to CAT. One of the things that you're going to do on Wednesday is we're going to create a template which gives us the multiples we're going to look at in the class. And the multiples we're going to look at the class, here's the custom template. Are these 6. EV to sales, EV to EBITDA, EV to EBIT, PE, PEG, and price to book. And what matters is the forward multiples, not the historical multiples. So how are the companies expected to do against future earnings? Because we care about future cash flows, right? So this is why you need a data service like Bloomberg or CapIQ or Thomson Reuters, because you can't get forward multiples and forward earnings from non-paid data services. Okay, so we're going to care more about the future multiples. So back to this. So what we'll do is we'll create our template and then we'll export it. And I'll give you a sense of what you're going to do on Wednesday. So I'll dump this to Excel. And one of the things you're going to quickly see, we'll make this a little bit bigger, is here's CAT and its peers. And EV to sales is a function of margin. So a company that has a higher margin will have a higher enterprise value to sales. A company with a lower margin will have a lower enterprise value to sales. So when I look at CAT, when I look at Bloomberg, average EV to sales for CAT's peers is 1.73. Average EV to sales for CAT is 1.08. And by the way, Komatsu's 1.33. So what I immediately know is that CAT has a lower expected margin than its peers, right? But here's what you'll get after you read the chapter, is that I actually, by looking at this data, just like the people in the Matrix could look at the green crap going across the screen and say they could see things out of it, I'm going to tell you that you can look at the data on this screen and there's data here that you'll start to see things that other people don't, right? Perfect for Halloween. So here's what I mean. One of the things that you'll look at is if I go here to this spreadsheet and I'll put in estimated margin, which is my EBIT margin. the estimated margin equals the EV to sales divided by the EV to EBIT. So right now, the estimated operating margin for peers in this industry is 8.8%. The estimated margin for all these other companies for CAT is 6.7%, and for Komatsu would be a different number, 11.8. But here's the point. CAT trades at a lower EV to sales because they have a lower estimated margin. And I can actually see that kind of hidden in plain sight. Okay? So this is why this also starts to become important. If the market is expecting, based on trading data today, that CAT's operating margin is a little under 7%. That's operating profit divided by sales. We have done a base case valuation for CAT. In our base case valuation for CAT, the as is, the hold, we forecasted an operating margin for CAT. The market is using 6.7%, and we're using something like 9%. So one of the things we tried to do in the as-is valuation is we tried to come up with what must the market be thinking. And what I did is I said very little growth and kind of okay margins. But now that I actually see how CAT is trading, what's the flaw in my as-is assumption? What's likely to have happened with CAT? What should I do? What's the market thinking about CAT? About their margins. Are my margins too high or too low in my model? My margins are too high, so I probably should lower the margins. Well, how do I still get a $72 stock price with lower margins? What would I have to change? What would I have to do with sales?
You have to go up.
I had to go up. So that's the point. When I did the as-is, I was justifying better margins and lower sales. But if I actually look at the trading multiples of CAT today, the market is actually saying the opposite. The market's saying worse margins, but better sales. Right? So again, this is how I could start to, and I'll use the word triangulate, what the multiples tell me and what my DCF tells me to get a more consistent story. Right? So one of the things is I was too aggressive at lowering the sales. And the market believes after 2 years of substantial declines that CAT is going to probably in the out years grow a lot faster. So that goes back to the point that he was making earlier when he said he sees some more upside in CAT and what they could do in an up cycle. And that was the point. I was being too pessimistic versus what the market's probably really thinking about CAT sales. And I was being too optimistic about the margin because it's probably going to continue to be a more competitive environment. So that will help me revise my scenario for coming up with a valuation of CAT. Now again, I'm not saying the market's right, but I'm saying that that's what the market's actually telling me. And it's sitting there as a data point that I could use when I do my valuation. Now that's just the enterprise value to sales multiple. There's 5 other multiples, and on Wednesday we'll talk about what those other multiples are telling us about the companies, and we'll start to see why companies trade at higher or lower multiples. So when Morgan Stanley does their valuations, Nicole's using multiples as her primary way of coming up with her bear case, bull case, and hold case. And the point is it's the same thing. And in either case, she has in her multiples an expression for expected growth, an expression for expected return, and an expression for cost of capital, because that's what's creating the multiples. So it's a similar process to what we're doing in our intrinsic value cash flow model. And so that's the approach we're going to take to multiples. And that's what I'm saying. That's your second homework assignment for next Monday, is to be able to look at a series of companies and figure out what is the market telling me about their expected growth and return based on how they're trading compared to their peers. And you'll quickly find that it's actually there if you know how to look for it, and that's what we're going to talk about on Wednesday. So my suggestion, if you haven't read the multiples chapter, read it before Wednesday. It'll definitely help you going into your next assignment. Okay? So before Wednesday, make sure one of your team members submits your stock track write-ups before Wednesday at 10 a.m. And come ready with Excel. So we will finish up the CAT multiples, and then we'll do another company in class, and then we'll hand out the assignment for your individual assignment for next Monday. Okay? This will be posted on YouTube, and I'll see everybody on Wednesday.